The rate of inflation is at an all-time high. What happened to inflation that wasn't a huge concern before the pandemic? Inflation is actually beneficial. It isn't completely negative. Of course, seeing the value of your hard-earned money plummet sucks. At the same time, it's a great way to encourage people to spend. Every dollar you spend multiplies into several dollars, which is how the economy expands. When you buy a $1 snack, keeping your money concealed in a bank account won't assist anyone, including you. That $1 is paid to the Toad's employees. They pay the rent with that money, the landlord spends it on a pair of clothes, and so on, until that single dollar has multiplied many times over. The issue is that when inflation is greater than normal, a 2% inflation rate is acceptable. However, consumer prices have been rising at a rate of 5 to 6% every month, raising the question of whether it is safe. Is the United States on the verge of hyperinflation, and will the currency lose its value? Unfortunately, we can't foretell what will happen in the future. We can only make educated guesses based on the information we now have. We can make several forecasts, and only God knows which one will come true. Whatever happens, if you want to be on the winning side, you should avoid holding a lot of cash and instead invest in assets with intrinsic value. Because the value of that item will climb in lockstep with inflation, if not faster. Take a look at the billionaires. None of them have that much cash. The number on the Forbes list represents the current market worth of their assets. So they don't worry about inflation. Instead, they focus on ensuring that their assets create enough cash flow to cover their expenses. However, inflation is not as bad as many people believe. Always keep in mind that every crisis is an opportunity. People are gaining huge riches as a result of the inflation. So in this video, I'm going to show you 7 ways that the wealthy profit from inflation. These are the tactics you can employ as well. But first, let me state unequivocally that this is not financial advice. And everything mentioned in this video is meant to be informative as well as entertaining. Let's get started with the first one. Real estate. Real estate is one of the world's oldest industries. It's probably as old as civilization itself, because we've always needed a place to call home. Of course, property prices do not typically climb as quickly as they have recently. However, they always keep up with inflation. A dollar in the 1990s was worth far more than it is now. However, the median property price was similarly around $100,000. Today's value is nearly $400,000. You would not have lost any money since 2020 if you had maintained your savings in real estate. Alternatively, since the start of the pandemic, the Fed has been printing money like there is no tomorrow, pouring trillions of dollars into the economy, causing huge inflation and skyrocketing consumer prices. Inflation has been substantially greater than the average 2% in the last 2 years. However, property values increased by more than 20%. Those who bought properties during the start of the epidemic benefited from the tremendous inflation, giving their dwellings an intrinsic value in comparison to the currency. The value of the dollar, or fiat money, that we use today is determined by what we feel it is worth. You can't consume it or utilize it for anything else, such as building a shelter. Aside from price appreciation, real estate generates cash flow, or a steady stream of revenue. Even Bill Gates got into real estate by amassing the largest private farming holdings in the United States. Second, most of us were taught as children that debt is the foundation of all evils, and there is some truth to this. Take a look at those who are having trouble paying their credit card payments. That debt is increasing by the day. It continues to grow in size. In certain circumstances, this rises to the point that the borrower can hardly afford to pay the interest on the debt. Indeed, debt has become an integral part of our culture. You want to go to college, so you'll get a student loan. You want to purchase a car, so you'll obtain bank financing. You want to buy a house, so you'll get a mortgage. However, if you've read even a basic personal finance book, you'll know that there's good debt and bad debt, and that good debt is incredibly profitable during inflation, as seen by the Fed's decision to cut interest rates to 0 last year. Every company that could receive a loan did so, including Apple and Microsoft, which did not require the funds. Borrowing money at practically 0% interest is essentially free money. Consider the case of real estate. If you borrow money at 1% and invest it in real estate that yields, say, 10%, you may sell the real estate at the end of the year, pay off your loan, and have 9% left over. We didn't even factor in the cash flow it generates. That is merely an example. Stocks are the third type of asset that I prefer. They're straightforward, simple to buy in, and quite liquid. Every stock represents a genuine company with actual products or services, as well as the real people who create them. If a company is robust, its value will climb in lockstep with inflation, if not quicker. Almost every objective I had in my portfolio has gained considerably, with the S&P 500 alone increasing by about 50% since the start of the pandemic, since the start of 2020. And this is due in large part to the fact that we experienced massive inflation. Even if inflation is 4 or 5%, which is significantly greater than the average, you will still win since the value of your assets will increase by a much larger percentage. Gold, number 4. If there is one thing we can be confident of, it is that gold will never lose its value because it has stood the test of time. Throughout history, gold has been the one asset that has always held its value, and in certain cases, increased in value. Whenever the future appears to be unpredictably uncertain, people are attracted to gold. Take a look at the price of gold. When the stock market collapses and there is a crash, when real estate values begin to fall, everyone turns to gold, which will maintain its worth no matter what occurs. However, once demand for a certain asset increases, so do prices. That's why when there's a lot of inflation, buying gold is one of the best ways to profit from it. The only issue is that once the crisis is past, gold prices begin to gradually decline. People prefer to invest in stocks and other assets when the future appears more predictable. Because gold isn't a liquid asset, there's only so much you can do with it. Gold is mostly utilized to safeguard riches. It's not the same as having an actual asset. It's not like real estate, which may generate regular passive revenue by simply sitting there and shining. So it's a good asset to have during moments of high inflation, but not so much during years of tremendous growth, because you can make much more by investing in businesses that generate things and services. Number 5. Cryptocurrency. Cryptocurrency is still in the early stages of development. It is, without a doubt, unstable. However, when the market fell in April 2020, Bitcoin, for example, was regarded as virtual gold. The market immediately recovered once the Fed assured the globe that it would back everyone. After the Fed announced the stimulus legislation, and that it would begin acquiring corporate bonds unless investors switched to stocks, gold, real estate, and other assets, no one wanted to keep cash. Crypto appears to have steadied to the point where individuals are now putting their money into it. So, for example, the price of Bitcoin has risen considerably since then. In January 2020, the price of Bitcoin was around $7,500. In comparison to its current price, that sounds like a joke. In fact, since the 2017 Bitcoin bubble, the price has been hovering around $7,000, with a low of $3,400 in December 2018. It's really a shame that the majority of people will miss out on buying Bitcoin at that price. It was only a few years ago. In any case, consumers began to resort to crypto last year as a method to protect their wealth from inflation. However, demand was so tremendous that the price surged. Bitcoin will reach a new high of $31,000 by the end of 2020. Bitcoin holders were ecstatic, and it appeared that a new bubble had popped. The key word, however, was seed, as it did not crash. The price continued to skyrocket, eventually reaching over $60,000. In the next few months before it crashed to around $30,000. That is still not bad. At the time of the script, it's still difficult to form an opinion about what the price of crypto would be. But what is certain for sure is that crypto is the future. Number 6. ETF. ETF, and probably the best financial investment of the 20th century. If people only understood the power of ETF, the entire world would have invested in them. Stocks individually, aggressively, no matter the company. Even companies like Apple that literally worth trillions of dollars are risky to an extent. The price of their shares is determined by the market. History is littered with stories of firms who purchased two boats only to see them evaporate in a couple of years after losing the edge to the Androdar. Remember when Kodak or Nokia ruled the world? Nokia had a monopoly on phones and accounted for a quarter of Finland's GDP at one point. As a result, there is always a danger, regardless of the organization. However, by diversifying your portfolio, you can eliminate this risk. That's when exchange-traded funds, ETF, come into play. They invest in a wide range of businesses. The most well-known is the S&P 500, which you may have heard of. Vanguard S&P 500, also known as VTI, is a mutual fund that I own. It invests in the top 500 companies in the United States, some of which may underperform. But traditionally, the most of them will outperform in the long run. They don't just cope with inflation. They consistently outperform it. Indeed, if you had borrowed money in 2020 and invested it in the S&P 500, you would have made a fortune. Since January 2020, the S&P 500 has increased by 47%. Despite the catastrophe, it increased by over 21% in 2020. So, if you borrowed $1 million at 2% interest and invested it in the S&P 500, you would have easily paid back the $1 million plus $2,000 in interest, leaving you with an extra $19,000. You would still be profitable even if inflation was 4%, 5%, or 7%. Number 7. Bonds. Government bonds are perhaps the safest investment you can make, second only to gold. U.S. government bonds will only fail if the United States fails. And, at least for the time being, that appears to be highly unlikely. When you buy a government bond, you are lending money to the government, and the government is borrowing money from you. The government, at the end of the day, requires funds to operate. As a result, it borrows money from companies, the Federal Reserve, and ordinary people like you and me to build schools, bridges, and infrastructure in order to increase people's productivity, allowing them to earn more and pay more taxes. You will struggle financially if you lose your job or your firm fails, but the government will not, because it can simply raise taxes, and you will have no choice but to pay them. So, if you lend your hard-earned money to the government, you can rest assured that the government will find a way to repay you. Keep in mind, however, that government bonds offer a very low rate of return. The current rate on 30-year bonds is 1.95%, which barely covers inflation. But it's better than nothing, right? That is preferable to holding your money in a bank account with a 5% interest rate. Because interest rates are low, bond rates are also low. Remember that when interest rates are so low, the government will not give you a higher interest rate, since they can borrow the same money at a much lower cost. In other words, interest rates have a direct impact on government bonds. It's extremely tough to maintain a large portfolio worth hundreds of millions of dollars, if not billions of dollars. You can't keep them all in real estate equities. Many large investors hold a portion of their portfolio in U.S. government bonds. They may not make a lot of money, but they will not lose money due to inflation. The most important thing to remember is that when there is a lot of inflation, paper money loses its value, since it has no fundamental worth. You want to invest in real estate that has real value and can withstand the test of time. If you don't have much savings, ETF might be a wonderful choice. If you're a professional investor, you should certainly investigate other asset classes as well. If you love this video, please give it the thumbs up it deserves and subscribe if you haven't already done so. Thank you for watching, and I'll see you next time.